Hi, my name is Kurt. I'm a value investor, and on this channel we look at undervalued stocks, stock valuations, and value investing principles to help us on our investing journey. On this video, I'm going to be talking about 5 undervalued stocks that I see a lot of potential for in 2024, even though the stock market has been really high lately and a lot of stocks are overvalued. We're looking for those companies with stocks that are low price to their true value ratio. So let's get into these 5 undervalued stocks that I identified. The first one is AGRO, or I don't know if I'm saying that right. It's a Brazilian company, and it's an agricultural company. They operate in Brazil, but they also operate in Argentina and Uruguay. So apologies if I'm not saying it perfectly. It's ticker symbol AGRO, AGRO. And this stock trades through an ADR, which means it's a foreign company, but it trades publicly in the United States, and therefore it meets all of the reporting requirements and accounting requirements needed to trade on public markets, like quarterly statements, quarterly financial statements, and annual reports. So this stock, because it's agricultural, has really been a cyclical stock that hasn't gone up wildly or down wildly throughout the years. A couple years ago during COVID, it dropped down to a pretty low point, you can see, but it's traded up since then, but it still hasn't crossed through any of those highs that it's reached on various occasions. So this stock has a potential to swing up and we could really capture momentum. Right now, it's in a little bit of a down spell. The price to earnings ratio on the company right now on the stock is around 7. And let's look into some more information about the stock. Now, we just saw the price has been fluctuating, but mostly flat for a while now. But the free cash flow on a rolling 12-month and on a rolling 2-year basis has trended up quite consistently. Although it does go through these cycles of cash flow increases and decreases, over time we can see that where it is now is much higher than it was a few years ago and a few years before that. So we see a consistent trend overall on a longer term period, which is nice. It has an 18% annual average growth in its free cash flow, whereas its price really hasn't grown in the last few years. So the booked value for this company, based on all the properties that they own farms and they own lots of equipment that has to do with agricultural production and even energy production. All of those assets are balanced by their debts, right? So we have their book value of $1.3 billion, but I adjust their book value to be on the conservative side and account for some losses on their assets and maybe for their liabilities to grow or something. So my adjusted book value for AGRO is $800 million. Right here, I just have some assumptions that I used to calculate the valuation for the company that I'm going to show on the next slide. So every valuation is based on assumptions. I'm showing my assumptions here, and you can comment down below for all 5 of these companies. If you don't agree with these assumptions, what would you change? Because we can plug your assumptions in to a formula for the discounted cash flow analysis, and we can come up with a valuation for the company. I actually have a video where I talk about the exact mathematics behind calculating a discounted cash flow analysis to value a company, and I'll link that. I'll put the card to that video right up top right now. But here are my assumptions. I assume of a base year free cash flow of $105 million. You can see on the chart here that the last 12 months has yielded $300 million in free cash flow. But if you go back in time, around the last year or two, $100 million is pretty fair, and it's been trailing up, but $100 million is pretty fair to assume for the base year, for the current year free cash flow. And for growth, I assume 15% growth over the next 5 years. I showed there on the slide that we've seen 18% per year growth over the last 10 years, I believe, or maybe that's 5. We've seen 18% annual growth over the last 5 years. So the next 5 years, I'm saying 15% annual growth. The next 15 years after that, I assume 8% per year growth and a perpetual growth of 3%, because this company deals in a product that will always continue growing with the economy. That is food production, because people need to continue eating. The margin of safety I assume for this company, or that I'm going to apply to this company, is 30%, which is the typical margin of safety that I tend to use. Some companies I'll use a 40% margin of safety, which means I reduce their valuation by 40%, or in this case, 30%. And some companies, if they're very steady companies, very reliable companies with little uncertainty, I set them to a 20% margin of safety. So it just depends on the type of company, and I can tweak that margin of safety how I see fit, or how I think is appropriate. So for AGRO, my expected return based on the current price and the value of all the future free cash flow, the discount rate that balances them is 32%. That's a 32% expected return, which is very, very high. And that's why it's landed on my top 5. And that's why it's landed on this list of 5 undervalued stocks. You can see the intrinsic values calculated with the 30% margin of safety at various discount rates listed there. Like at 10% discount rate, then $37 a share should be the price. And keep in mind, the stock is trading around $10 a share. So at 15% discount, $20 a share, that's twice what it is now. So you could get a 15% yield even if the stock was priced twice as high as it is today. So you can see there $15 a share for 20% yield, $12 a share for 25% yield, and the yield based on the current price is 32%. That's the discount rate that balances the price and the value of all the future free cash flow plus their current book value. I also do a pillar analysis to show the stability of the company's earnings, their balance sheet. If they pay a dividend, is it too high? Their valuation. So all these pillars talk about the predictability of the business and the quality of the business. And AGRO meets 7 of the 8 main pillars and 16 of the 21 sub-pillars. So it's not by far the best stock I've ever covered, but it's in that top tier. 7 out of 8, 16 and up tends to be fairly solid company with some uncertainty, but not a ton. So for me, I'm going to be buying this stock under $15 because under $15, I feel like I can get a great return on that investment. And I'll start to sell once the stock gets above $15, all the way up until it gets to $20. I might hold on a little bit more than that, just depends. But this isn't a company that I see being super high valued for a long time, so I don't want to continue holding it that long. Once it pops up from where I'm buying now at $10 to around 15, 16, 17, 18, up to 20, I'll be selling. I'll probably hold on until it gets to 20 and sell through there. And if I have to hold on to more shares, I will. But again, this process of the price recognizing the fair value of the company can take many years. It can take many months. So all of these companies, if you buy into, these expected returns are not guaranteed to happen overnight. So you have to hold it and hope that your analysis is correct. And that's what we're hoping for these stocks. Now, I've been buying some of these stocks, and I'm going to be looking to buy them in my $1 Million Challenge investment portfolio that I cover on this channel. So if you want to continue to watch stock valuation videos and see my journey in that portfolio, hit the subscribe button and make sure to follow along. The next stock on my list is Mastercraft, ticker symbol MCFT, and they manufacture and design and sell boats. They manufacture recreational fast boats, power boats they call them. The company has over 1,000 employees, but it's still a small company there. It's headquartered in Tennessee, and you can see the price chart that they've traded way down from earlier in 2023. About this time, 2023, they traded from around $35 all the way down to around $20. So this is a stock where I see a little bit of a cyclical price action. I feel like this is a good time to buy into the company, assuming that the financials are all good. The price to earnings ratio on this company is about 6.5. So again, we're finding companies that the PE ratio is less than 10 and they're good quality companies. This is their free cash flow chart in rolling 12-month and rolling 2-year average. And the first thing that you can notice is that it does obviously trend up, but it's really had a big surge in free cash flow starting in 2022, and it started to come down in 2023. So that leaves us in a position where we should ask the question, what's going to happen in the future? And can the company carve out a base, a trough in that dip that it's currently experiencing at a point where we can expect growth into the future? I drew a dotted line and a purple bubble to kind of show you where I'm thinking that the free cash flow will bottom out and start troughing and increasing again. And if that happens, we can target somewhere around there for our base year free cash flow, and then we can project growth from there, because they were experiencing growth before COVID, before 2020, and they had a dip, but they've really come out of it strong. So all of these things together, we're not 100% sure about the future of Mastercraft, but if we make some basic assumptions, that chart, it has positive free cash flow, it has positive earnings, so those kind of things are solid. At least we're not dealing with a company that's currently losing money and we're just hoping for it to turn around. No, it's the free cash flow is coming down and people are trying to guess, where is it going to come down to? How far will the free cash flow drop before it returns to continuing growth? The book value for Mastercraft on their balance sheet is $192 million. I adjusted that to $129 million. And one thing to note that's great about companies like this, when you find a company with a healthy balance sheet, that is awesome. This company has more cash on hand than they have current debt, and their cash on hand is greater than half of all their debt. So they could pay off all their current liabilities with the cash they have on hand. That's awesome. And when their cash on hand makes up half of their total debt, to me, that's a really good position. It puts them in a position where even if they have tough times, they can get through. I'm going to assume a base year free cash flow of $50 million. Now, right now, their 2-year average is at 80 million. Their 1-year rolling average is just below 80 million, maybe 70, 75. I'm expecting it to continue to drop, but I expect it to reach an area around 50 million because they were consistently making over 40 million in free cash flow going back multiple years. So I think that they can establish a $50 million base, and they can grow from there at 18% over the next 5 years, 8% over the next 15 years after that. And I expect a perpetual growth of 2% with a margin of safety of 40% because there's a lot of uncertainty here. So we're going to take our valuation straight from the numbers, and when I report it, it's going to be reduced by 40% just for safety and just to be on the conservative side. So what does that leave us? Well, that leaves us with an expected return of 29% per year. So that's, again, the discount rate that balances the price of the stock currently with all of the value of their future free cash flow with their balance sheet, their assets minus liabilities incorporated there. And so we can see here with the 40% margin of safety, if you're looking for a 10% yield, you should pay $105 for the stock. A 15% yield, you should pay $51 per share. Right now, the stock is below $24. It's at $21 per share. So even if you wanted a 25% yield, with all of our assumptions, you should pay $24 a share for the stock. And so this is a really high potential to make good returns. The pillars, again, 7 of 8 of the main pillars and 16 out of 21 of the sub pillars, just like AGRO. I'm going to be buying the company at less than $30. I'm going to be averaging in right now 21. I've already opened a position on Mastercraft, and I'll be selling after it gets above $40. I think $40 to $50 sell range is going to yield great returns, and you're still going to be before it gets to that 15% yield situation. But we'll have to monitor the stock, see where the free cash flow goes in the next few months. The next stock is Cincinnati Financial, which is a lot more stable of a company. You can see their price history has gone up very consistently, steadily over the years, over many years. Cincinnati Financial is actually a dividend king. They've paid an increasing dividend for 62 consecutive years. And this company offers life insurance. It offers home insurance, and it offers some commercial insurance, I believe. So they're an insurance company. They manage an investment portfolio for all their to keep their funds well, so they can continue to pay their liabilities from insurance claims. And they are trading right now pretty well below their all-time high, which was at $140 a share. And this company's in the S&P 500. It has a $17 billion market cap, which, you know, for all the insurance companies in the S&P 500, it's actually pretty low down that list. 17 billion is actually quite low for a big insurance, you know, for an insurance company with a brand and with so much consistency. So I kind of like the small nature of Cincinnati Financial in the terms of it's not a mega it's not like a mega cap stock. And here's their free cash flow trend. So even though the price has come down notably over the last few months, from $140 right now, it's around $110 a share. The free cash flows continued to go up very steadily. It had a big dip around 2017 to 2018 in free cash flow, which sort of seems like an anomaly because outside of that, it has just consistently grown and grown and grown. So it has predictable free cash flow, very steadily up. It has some risk, obviously, like any insurance company, from like how many claims are filed in a given year. Could really harm their bottom line and their free cash flow. That might have happened in 2017. They just had an anomaly, just more claims than usual, more claims than they expected. But these companies are always trying to adjust their underwriting process and using data now to really hone in and make smart decisions about pricing for different policies, etc. Their book value is $10.5 billion, but I corrected that down to $7.6 billion. I gave a little bit of extra cushion because of this company has a lot of potential for increased liabilities. I'm going to assume a base year free cash flow of $1.75 billion, even though currently they're making over $2 billion in free cash flow per year. I'm going to assume a base year of 1.75, and just in case it drops some, and growth over the next 5 years of 14% per year. After that, 8% per year with a perpetual growth of 3% per year and a margin of safety of 30, just because they can carry some risk, but this company has been so steady for so long, really, it would make a lot of sense to me to use a 25% or even 20% margin of safety. But just to be conservative, we're using 30%, and let's see where that gets us. It gets us an expected return of 25%. And again, with that margin of safety, you can see the different discount rates here, 10% through 25%. This is where they are currently at $110 per share, and that would equate to our 25% expected return. But even if you were okay with a 15% return, you should be buying Cincinnati Financial at $200 a share. So the point here is that I'm going to be buying under $120 a share pretty aggressively, and I'm going to sell this company as they approach that $200 per share mark, because that is a good return at 15% for a steady, stable company. Really, the market should value them a lot higher. But here you'll see that they carry 6 of the 8 pillars. They got docked a little bit, but they have 17 of the 21 sub-pillars. So overall, very stable company. Dividend king, 62 years of increasing consecutive dividends, of consecutive dividend increases. So awesome company for 25% yield. This should be a company that any value investor should be looking at. PayPal, of course, is going to be on the list. I covered PayPal a couple months ago and got a lot of attention for it to my channel, and a lot of people were commenting. PayPal right now is just, it divides people. Some people think it's just a terrible company. They're wasting potential. They're going downhill. Some people think they've got so much going and they just need to fix a couple things and their free cash flow is going to skyrocket and they're going to do great at this price especially. Now you can see what I've shown you here, and why it piques the interest of value investors is look at this trend in their stock price, followed by, at $300 a share a couple years ago, a huge collapse, of course, from interest rates going up. That harmed them, obviously, but they've really continued to trade down and down and down. Now they're under $60 a share, whereas before the pandemic, they were at $120 a share. So the question is, why are they so low? Now, their price to earnings ratio is 15, so it's higher than the first couple that we covered at less than 10 price to earnings ratio, but still 15 price to earnings ratio for a company that has a potential to grow. So we're going to ask a question: does PayPal have the potential to grow? I covered the secular growth trends when I reviewed PayPal and did a stock analysis, full stock analysis on it. We haven't had any financial statements since then, except there was a release a few days ago. Their guidance was lower than expectations, but they were still growing in revenue and growing in net income. PayPal, obviously, their business is mobile and online payments. They're trading at 19% of their all-time high, which was at $308. They've been buying shares back while their stock has been cheap, which is awesome to me. And they have a higher free cash flow today, and they have a 68% higher earnings today than they had pre-pandemic, but half the share price. So to me, that's just crazy. Maybe they were overpriced before the pandemic, sure. But let's take a look and see if we do our own discounted cash flow analysis based on where they are today, are they a good buy? And those are some of their brands that I'm showing here, like Venmo. Remember, they own Venmo, Braintree, Paydiant, and they've been really changing the way they're working with merchants to put PayPal as an option on their websites. And you'll see PayPal a lot if you're buying things online from various websites. PayPal is an option to pay because a lot of people have a PayPal account. This is their free cash flow in the light blue. They're rolling 2-year free cash flow in the dark blue, and their net income in trailing 12 months in the green line. So they've lacked execution, and they're a little bit stalling here between 2021 and currently. They've slightly declined in free cash flow, and they've slightly declined in earnings, but from a long-term perspective, you can still see that the business should trend upward, and the space that they're in is obviously a growing space. They did lower their guidance for 2024 a few days ago, and so that raises some concerns as well. Their booked value is $18.7 billion. Their adjusted book value, according to my adjustments, are $12.7 billion. So that's what we're going to use. I'm going to assume a base year free cash flow of $3.8 billion. That may be highly controversial because right now their trailing 12 months is only at about $3 billion. However, their trailing 2-year free cash flow is up over $4 billion, and I expect their free cash flow to go up in terms with their earnings. Look at their earnings are above $4 billion trailing 12 months. So I expect over the next few months for their free cash flow to continue to trend up, and I'm going to use 3.8. You could use 3.2. You could use even $3 billion, and if you're really conservative and think the company is just collapsing, you can start with a base of 2.5 billion or something. But I don't see why you would project any growth in the company then, and you should just throw the company away if you don't think they're going to grow. If you think they're going to grow, though, and the growth assumptions I use are 12% next 5 years, 7% after that, and 3% perpetual, then I think that somewhere between 3 and 4 billion is a fair assessment for their current free cash flow to project from. And that leaves us with a 30% margin of safety at a 15% expected return. Now, you may be saying, why would we be getting crazy for 15%? I mean, yeah, that's good, but it's not amazing, and PayPal has a lot of risk for that. But when you look at their pillars, they're not a risky business. Out of their main pillars, they have 7 of 8, and they show 17 of 21 sub-pillars. The company's been going for a while. They have a lot of promising things. It's like if you're going to take a risk for PayPal to collapse or PayPal to take off, all of their assets, everything they have, and the things that they're working through right now point to you should probably wager on them growing rather than shrinking long-term and dying long-term. And I think it's a company that could surprise to the upside, and the market could really overvalue the company, so you could be surprised above these fair value numbers. The market could spring the price back up and put them in an overvalued position in the future. So that's what I see about PayPal. That's why it's on my list. I'm going to be buying as it's less than $60. As it gets highly above 60, like let's say it starts to approach $70, I'm not buying anymore. But right now, below 65, especially below $60 a share, I'm buying. I own PayPal, and then I'm going to sell once it gets to about $80 to $100, maybe up to $110, because by that time, they're going to be approaching that 10% expected yield. And so I think that will be the point to cash in. The last company on the list is Medifast. Medifast is a nutrition and weight loss foods and coaching services provider. Their flagship program is called Optavia. A lot of people have complained that Medifast is like a multi-level marketing scheme, kind of not great. And I kind of agree with that. Obviously, they have multi-level marketing type business model. However, I think they do solve a problem for a lot of people, and I think their earnings speak for themselves over a long period of time. People use Optavia because it helps them. The company uses coaches to sell more products and push more products, but to me, that's like any store that has franchises that push their product. McDonald's does that too. The problem becomes when people are kind of pressured into a certain lifestyle or cult, and then they feel like they have to be a coach and they're promised to earn money, but they give into it. So I don't like people being ripped off. I haven't seen anything specifically from this company that shows that. They do have a system where people can become coaches and then sell products to people that they know and friends and build like a network. And that network is used in their program to help people stay accountable to lose weight. I've heard a lot of bad things about, hey, the food they offer and that they prescribe is very low calorie. It's basically starving people. I think that was mostly in the past. I think they're doing something a little bit different now. But to me, it doesn't make sense as a company to prescribe not feeding people. To me, it makes sense as a company to prescribe people to eat, to consume more products that you have, so to eat higher calories or a healthy amount of calories. But what they probably do is they sell $10, something that costs them $2 to make. So that's what they do. They make the food, they sell it through their system. Right now, though, they've seen an enormous price collapse in their stock. They actually had this before. They were at $250 a share back in 2018, and it crashed, kind of dipped all the way down. It was troughing, it seemed like, before the pandemic, right in 2020, $100 a share, and it dropped substantially, but then it spiked all the way back up. People were spending their money. People want to stay healthy and lose weight. They were in the program. The company has continued to make revenue increases, but recently the revenue has started to come down, the profit has started to come down, the free cash flow has started to come down from enormously high levels. So it's a situation very similar to Mastercraft. The price to earnings ratio is less than 5 right now. The free cash flow per share is 2.5 times higher than pre-pandemic. 2.5 times higher, but the share price is half. So let's look at their free cash flow. This is what it looks like. This is that really scary picture, that terrible falling free cash flow. Yeah, it fell from 200 million and it's going to be falling, who knows, 150, 100 million. But look at the long-term trend in growth. Before the pandemic, it was growing, and after the pandemic, it grew a lot, came back down, but then they recovered to a new super huge high. So there is a cyclicality, maybe a business decision that they invested a lot here in capital expenditures, and then they made a lot of cash here. Their earnings have started to come down, so I expect the free cash flow to come down. The forecasts from analysts show lower earnings in 2024, but they expect the company to return to a positive trend after that. So their book value is 190 million. I adjusted it to 165 million. They have a great balance sheet. I assume $75 million base year. That is really low. They could trough out at 125. They could trough out at 100, but I'm assuming 75 just to be extra safe. That's about where they were in 2019. I'm expecting 14% per year growth. That's very in line with what they've done and even less than what they've done. I expect 5% growth in the next 15 years after that, and I expect them to decline in perpetuity because it's not a business that I think is going to be around 50 years from now, 100 years from now, whatever. I'm going to use a 40% margin of safety because of all these risks and concerns that we've talked about, and here's where that leaves us at an expected return of 22%. I felt like I was as conservative as I could possibly be, and we're still at a 22% return. That means any surprise to the upside, I'm looking at great returns for this company. They meet 8 pillars out of 8 and 20 out of 21 sub-pillars. Very steady, growing company, great balance sheet. They don't have dividend problems right now, and they do pay a dividend, by the way. So I'm going to be buying at under $60 a share. I've been buying. I have a large position in Medifast, and I'm going to be selling around $80 to $130. So in that $100 range, that's what I'm going to be trying to cash in. That should be huge gains. And really, we could keep going more than that, depending on how much they start to surprise us to the upside. Where do they trough in free cash flow and start growing? Those were my 5 undervalued stocks. And I have some other opportunities here, some honorable mentions, if you will. And these are not going to be hitting huge home runs, except maybe you can say Chegg and NVR. But American Express, 19% expected return, same process I did for all of these. Here I'm showing the pillars and the sub-pillars so you can see how steady the companies are. and where I would buy and sell the stock. American Express is a great opportunity to me. Google is a great opportunity to me for how steady of a company it is. 18% yield return is great. Quannex Building Products and Chegg is a very interesting one, has a lot more risk than the others. And NVR is a mega home building company which has turned into a huge investing opportunity. I mean, they've turned their stock into basically a monster by buying back shares. So very interesting story on NVR. I would like to do a video covering all of these stocks very soon, so stay tuned if you want to see that. Depth discounted free cash flow analysis and valuation for each of these companies coming soon. And just remember that this is all based on my analysis. I entreat you to do your own analysis, do your own studying, watch my video on how to value a business, and don't just listen to me and buy because I said that they're good opportunities, but I'm just pointing these out. Maybe you can add them to your watch list, and I would love to hear what you think about these companies. So comment, what are some of your best value stock opportunities right now? Make sure to subscribe, and if this video has provided you any value, I'd love for you to hit the like button to show me that appreciation. I'll see you all in the next video. Best of luck investing.